What if the car you're driving today belonged to a brand that may not exist in 5 years? Several well-known European automakers are now in steep decline. Showrooms are closing, sales are collapsing, and most consumers aren't even aware it's happening. This video reveals 10 car brands that are disappearing in plain sight. Jaguar was once one of Britain's proudest names, known for its elegant sedans and powerful sports cars. But by 2025, most of its lineup had been cancelled with no replacements. The XE, XF, F-Type, E-Pace and I-Pace discontinued. Jaguar planned to go fully electric under a revised Tata strategy, but the rollout stalled. By late 2024, its UK sales had stopped completely. Then came the collapse. In April 2025, Jaguar registered just 49 vehicles across all of Europe. That wasn't 4,900, just 49. Compared to the same month in 2024, this marked a 97.5% drop. While BMW, Audi and Mercedes continued to sell tens of thousands of units monthly, Jaguar had virtually disappeared. Long-time customers were left frustrated. Some had waited months for deliveries, only to be told their model had been axed. The few remaining fans watched the brand they once admired vanish. Jaguar's promised electric lineup remained delayed, with nothing but design sketches and early concepts in circulation. The company rebranded itself with the slogan, "Copy Nothing," dropped its iconic badge, and tried to pivot forward as if nothing was wrong. But by early 2025, Jaguar had no market volume, no customer momentum, and no practical future on the road. Financially, Jaguar Land Rover was already losing money. The near-zero sales figures in 2025 only deepened the losses. Dealerships began to shut down, and showrooms went dark. Consumer interest faded. The few customers who still walked into dealerships found empty lots and left. Jaguar's survival now hinges on a future electric SUV and sedan, models that haven't been released or shown publicly. Unless these vehicles arrive soon and succeed immediately, Jaguar risks disappearing entirely. This isn't a brand in trouble, it's a brand in freefall.
Lancia, once a pillar of Italian automotive design and motorsport heritage, is now reduced to a single model, the Ypsilon. Known in the past for its rally dominance and stylish city cars, by 2025, the brand was surviving on a thin thread. Stellantis attempted to revive Lancia with a new Ypsilon in 2024. It came with bold advertising and a stated goal to re-expand across Europe, but the market's response was disappointing. In the first 2 months of 2025, Lancia sold just 2,228 vehicles across all of Europe. In the same period a year earlier, that figure had been 8,098. That's a 73% decline, despite the introduction of an updated model. Worse, the older Ypsilon had previously performed better in Italy alone than the new one did across the entire continent. The brand's attempt to re-enter markets such as France, Spain, Belgium and the Netherlands yielded little impact. Few dealerships existed, and customer recognition was minimal. Sales were almost non-existent. Stellantis had pledged to open 70 new Lancia dealerships by the end of 2025, but based on current performance, that target looks increasingly unrealistic. The current Ypsilon is available as a mild hybrid or a small electric hatchback, but neither variant has made a significant impression. Lancia has announced a larger electric crossover, the Gamma, for 2026, and a potential return of the Delta hatchback in 2028, but these plans are years away. As of now, Lancia's entire offering consists of one compact model with minimal visibility and declining market share. Financially, Lancia is insignificant within the larger Stellantis group. It doesn't generate meaningful profit, nor does it command consumer excitement. There's no major scandal or controversy, just steady decline. While the broader European car market saw modest growth in early 2025, Lancia continued to shrink. Without a clear turnaround, the brand's fate appears sealed. It's not just failing to compete, it's moving backward. Smart was once a fixture in European cities. Its compact cars were built for urban mobility, easy to park, inexpensive to run, and instantly recognizable. But by 2025, the brand had lost its footing. What began as an innovative experiment under Daimler had become a fragile brand struggling to stay relevant. In 2020, Mercedes transferred Smart into a joint venture with China's Geely, aiming to reposition it as an electric-only brand. The transition meant abandoning the familiar 4.2 and 4.4 in favor of battery-powered crossovers like the smart #1 and #3, but the shift hasn't delivered results. By early 2025, smart sales in Europe had dropped by 55%. Worse, all new smart vehicles are manufactured in China, making them vulnerable to growing EU-China trade tensions. In January 2025, the European Union launched an investigation into Chinese EV imports, citing state subsidies and unfair pricing. Smart vehicles were among the targets. As a result, Smart now faces a potential 18.8% import tax on each vehicle it brings to Europe. Some policymakers are even pushing for a 30% tariff. Mercedes and Geely responded by filing lawsuits against the EU, but their leadership acknowledged the risk. The Smart CEO publicly stated that these tariffs could be fatal for the brand unless European production is established. That's a tall order. Smart's original plant in Hambach, France, was shut down in early 2025. No new production facility exists in Germany, France, or elsewhere in Europe. Every smart car must be shipped from China, leaving it fully exposed to import duties. If tariffs like the proposed 38% on mini EVs take effect, prices would jump significantly. Meanwhile, brand visibility is fading. Dedicated smart dealerships are gone. Today, smart models are squeezed into Mercedes showrooms if they're present at all. Sales staff often redirect customers to other vehicles. The problem isn't product quality or brand perception, it's logistics, policy, and economics. Smart no longer sells enough units to break even. Without local production and facing rising tariffs, its position in Europe is no longer sustainable.
Mitsubishi once had a strong presence across Europe. In the late 1990s and early 2000s, models like the Outlander, Colts, and Pajero were common sights. The brand was known for durability and practicality. But by 2025, that image is gone, and Mitsubishi is effectively exiting the European market. The decline didn't happen overnight. In 2020, Mitsubishi quietly announced it would stop investing in its European operations. The strategy was simple: continue selling existing models until they failed to meet emission standards, then withdraw. No new platforms, no EV roadmap, and no local product development followed. By 2024, the brand's top-selling models, the Outlander and ASX, were outdated and poorly positioned. There were no redesigns, no innovation, and minimal marketing. The brand entered a prolonged decline. Sales data confirmed the trend. In 2024, Mitsubishi sold approximately 50,000 vehicles across the EU. For a mainstream automaker, that figure is extremely low. The dealer network also deteriorated. Many Mitsubishi showrooms closed. The few that remain focus mostly on servicing older vehicles. There is no growth narrative, only managed decline. Mitsubishi's selection and concentration strategy redirected focus towards the Asia-Pacific region, leaving Europe to alliance partners Renault and Nissan. While those two invested heavily in hybrid and electric platforms, Mitsubishi did not follow suit. One exception was the plug-in hybrid Outlander, but it was pulled from production in early 2024 with no replacement announced. Capital investment in Europe was cut entirely. No new technologies, no expansion plans, and no visible path forward. Past scandals, such as fuel economy manipulation in the 2010s, have faded from public memory, not due to resolution, but due to irrelevance. Few talk about Mitsubishi now because the brand has largely vanished from the conversation. In Europe, Mitsubishi isn't struggling, it's already halfway out the door. Suzuki has long been associated with affordable, reliable compact cars. As recently as 2023, the brand sold 264,000 vehicles across Europe, a strong figure in a competitive market. But behind those numbers, signs of trouble were emerging. The automotive landscape in Europe shifted rapidly. While Suzuki had announced plans for 5 electric vehicles by 2030 and a $4.5 trillion investment, execution lagged. By late 2024, company leadership, including President Toshihiro Suzuki, began issuing warnings. EV sales were slowing, and Chinese automakers were flooding the market with cheaper electric alternatives. Suzuki openly acknowledged it couldn't compete on cost. Market share across Europe had dropped to just 1.4%. Sales in 2024 had either plateaued or declined slightly. Suzuki's only full EV, the EVX, wouldn't begin deliveries until mid-2025. The bulk of current sales still came from traditional petrol models and mild hybrids like the Swift and Jimny. Dealership presence was also shrinking. Suzuki never had a robust standalone dealer network in Europe. Most outlets were shared with Toyota. Now even those dealers were becoming hesitant to stock slow-moving EVs. Technical support was limited.
While Suzuki promised to maintain service for existing models, technicians lacked tools and training for the EV transition. The brand was still operating, but without real forward momentum. Globally, Suzuki remains financially stable thanks to its alliance with Toyota. But in Europe, the business is increasingly unprofitable. The European branch feels more like a cost center than a growth market. There is no scandal or leadership crisis, just a clear struggle to adapt. And if the EU introduces stricter CO2 emissions targets or raises penalties for petrol vehicles, Suzuki may be forced to make a decision: invest heavily or pull back. At this stage, Suzuki is still present in Europe, but barely moving forward. Without a competitive, affordable EV within the next 1 to 2 years, the brand risks falling into irrelevance.
Mini built its reputation on charm, compact dimensions, retro styling, and a fun driving experience. But by 2025, the brand had undergone a drastic transformation. Now, under BMW ownership, every new Mini is electric. On paper, that sounds progressive. In practice, it's complicated. None of the new Minis are built in Europe. Instead, they come from a joint venture between BMW and China's Great Wall Motors. Every unit is manufactured in China, not in Oxford or Germany. That decision has placed the brand in a precarious position. In mid-2024, the European Union proposed a 38.1% tariff on Chinese-made electric vehicles. If enacted, this would severely impact Mini's pricing and competitiveness. BMW described the potential tariff as a terminal blow to Mini's future in Europe. The company had planned to invest £600 million to retool the Oxford factory for EV production. But with slowing EV demand and tariff uncertainty, those plans were paused. Until local production resumes, Mini's entire European strategy depends on trade policy. If EU-China negotiations fail and tariffs proceed, prices for Mini EVs will surge. That would make the brand less viable in a segment already sensitive to pricing. Dealers, many of them existing BMW outlets, are also under pressure. Selling a Mini becomes harder when its price suddenly jumps by thousands of euros. On top of that, the brand's identity is shifting. These are no longer the small, playful hatches that defined Mini. Today's lineup consists mostly of electric crossovers, larger, quieter, and far less distinctive. Financially, Mini was never a high-volume brand, but it helped BMW meet fleet-wide emissions targets. If Mini sales collapse under tariffs, that shortfall could hurt BMW's compliance metrics and profitability. In short, Mini's future in Europe no longer hinges on brand appeal or innovation. It depends almost entirely on geopolitics. Without tariff relief or a return to local production, Mini risks being priced out of the market. NIO entered Europe with high expectations. Marketed as the Chinese Tesla, it generated buzz with sleek electric SUVs like the ES8 and ES6, launched first in Norway. But by 2025, the company had failed to build real momentum across the continent. Sales remained low, just a few thousand units per year. The issue wasn't the vehicles themselves, it was the lack of infrastructure and support. Unlike traditional automakers, NIO didn't invest in a full-scale dealer and service network. Instead, it relied on online sales and battery swap stations, a model that works in China but hasn't translated well to Europe. European customers still expect local dealers and reliable service centers. By 2025, that expectation had turned into a liability. In April, NIO delayed its launch of the budget-oriented Firefly model. The reason? It couldn't secure enough partners to handle sales and service. That raised serious concerns about long-term viability. NIO's physical presence in Europe is minimal. A few service points in Norway and Sweden, and a small number of franchise operations elsewhere. Compared to legacy automakers, the footprint is negligible. For potential buyers, that creates uncertainty. Who will maintain the vehicle? Where can they get parts or repairs? Most aren't willing to take that risk with an unfamiliar brand. Financially, the situation is fragile. NIO's parent company continues to burn through cash globally. Without strong European sales, there's little justification to continue investing in the region. Some insiders have said that if the Firefly fails to gain traction, NIO could pull out of Europe entirely. Other Chinese automakers like BYD and XPeng are moving aggressively, setting up proper networks, investing in visibility, and building consumer trust. NIO, in contrast, is lagging behind. Its slow rollout and support gaps are proving costly. Despite the futuristic branding, NIO is now on unstable ground in Europe. Without rapid infrastructure improvements and stronger partnerships, the company may exit the market altogether.
DS Automobiles was created to be France's answer to Audi and BMW. Born from Citroën and backed by Stellantis, it launched with bold styling and premium ambitions. But more than a decade later, DS remains on the fringe of the European market. In 2022, DS sold just 37,480 cars across Europe, a 22% decline from the previous year. For comparison, Lexus, often criticized for weak European performance, outsold DS. In fact, DS's volume is closer to ultra-niche brands like Bentley than to any mainstream premium competitor. The product lineup includes the DS3 Crossback, DS4, DS7, and DS9. While visually distinctive, these models are often seen as overpriced and confusingly positioned. The brand message lacks clarity, and marketing efforts have failed to make a lasting impression. Electrification efforts are underway with hybrid and electric versions of most models, but sales have not improved. One major weakness is visibility. DS has very few dedicated showrooms. Most were opened post-2014 and are concentrated in France and the UK. In many markets, DS cars are sold through Citroën dealers as a secondary offering. That undermines the brand's premium image and makes service access inconsistent. For buyers, a lack of dedicated DS service points raises concerns. If something goes wrong, where do they turn? This lack of confidence adds another barrier to already limited demand. Behind the scenes, DS likely operates at a loss. Without the volume of Audi or Mercedes, every new model carries high per-unit development costs. Stellantis has the resources to support DS for now, but patience may not last forever. CEO Carlos Tavares once suggested DS might move even more upscale to challenge Bentley, but with sales declining, that now seems unrealistic. Unless DS can significantly increase volume or command higher margins soon, Stellantis may choose to cut its losses. The group already owns profitable brands like Peugeot, Fiat, and Opel. DS, by contrast, is shrinking and may soon fade without much notice. Morgan is one of Britain's oldest car manufacturers and has always followed its own path. While others modernized, Morgan stuck to hand-built sports cars, wooden frames, and vintage design. But charm alone doesn't satisfy emissions regulations, and that's where the brand now faces existential risk. Morgan produces only about 2,500 cars per year. That low volume has, so far, allowed it to avoid some of the EU's strictest emissions rules. But this protection is temporary. In February 2025, Morgan's managing director publicly admitted that the 2030 petrol ban was a hard deadline, signaling mounting pressure. After 2030, most new petrol vehicles, including hybrids, will be banned across the UK and much of Europe. The problem: Morgan hasn't developed a single hybrid or electric vehicle. There are no EV prototypes, no concept models, no announced plans. Outside of its Malvern factory, Morgan has little dealer presence. After-sales support is minimal. Financially, the company is stable, but barely. It earns no major profit and has no mass market potential. Morgan is essentially gambling on regulatory leniency. If that disappears, so does the brand. Alfa Romeo, once praised by Enzo Ferrari himself, now survives on reputation more than results. Its lineup, the Giulia, Stelvio, and Tonale, continues to shrink in relevance. In 2024, US sales fell 19%. European sales have followed the same downward trend for years. Alfa had announced it would go fully electric by 2027, but in January 2025, it reversed course. Petrol and hybrid models will now remain in production longer. Executives admitted their network, with just 118 US dealers and limited European reach, couldn't support a full EV transition. Stellantis continues to invest in electrification, but Alfa lags behind. Aside from a plug-in Tonale and a compact hatchback called Junior, little innovation is visible. While the Junior model caused a brief sales spike in early 2025, the rest of the lineup continues to underperform. The imbalance is not sustainable. Combined with weak infrastructure and slowing momentum, Alfa risks losing its place in the market. Across Europe, legacy brands are fading, some quietly, others quickly. Regulation, electrification, and shifting economics are reshaping the industry, and many of these names may not survive the transition.